Welcome everyone to Vested Interest. This is Shane, and this is our weekly portfolio update video. We did add $1,911 to the portfolio. We'll also cover any dividends we received and any options we were in for the week. But before we get too far in the video, I would like to take a moment to thank everyone who's taken the time to watch, comment, and like the videos, and a special thank you to those who subscribe to the channel. I really do appreciate it. For those of you who may be stopping by for the first time, on this channel, we focus on dividend growth investing. It's not rocket science, in my opinion. The best way to do anything, keep it as simple as possible. So it really boils down to consistently investing, dollar cost averaging. On this channel, we do that on a weekly basis into the portfolio. That's what this video is. Into companies, growing companies with positive cash flow that covers the dividend and companies with a high return on their invested capital. I utilized both a dollar cost average approach, consistently investing, like I said, into the portfolio on a weekly basis, but I also do larger purchases. I'll stack a little bit of cash on the side over time to deploy into the portfolio. I also will do that whenever I get my bonus, usually around the end of March, first part of April. And if I was to get any extra funds from a side job or something like that, I would invest that into the portfolio as well. I do cover all my investments into the portfolio on the channel. It is free to see what I'm doing. I don't have a paid Patreon account. I may open a Patreon account. I guess you can do the free Patreon account. Maybe we'll do that. If some of you are interested, let me know in the comments section down below. Like I said, it is free to see what I'm doing. But if you would like to help out the channel, it is free to do these things, and it doesn't cost you but a second of your time. If you can hit that thumbs up button down below if you find any value in the content, if you are a dividend growth investor, make sure you're subscribed to the channel. Join us on this journey to financial freedom. Join the Vested Interest community. Click the notification bell so you're notified whenever we put out any new content. I do this portfolio update video every Sunday morning. I also do a stock pick of the day video series Monday through Thursday whenever the market's open. We take a look at a company stock that's pulled back on the day to see if it is presenting any value and makes it onto my watch list for more of a deep dive into the company. And there is the thanks button down below if you'd like to help out the channel by buying me a cup of tea. I don't drink coffee, but a cup of tea down there. If you click on that thanks button, you can see several tiers in there for those of you who are capable of doing so. And again, very special thank you to the subscribers out there and the viewers of the channel. The channel continues to grow because of people like you. All right, let's get back into the update. We'll start off with options. We did have a little bit of luck there right as 2024 wrapped up with a couple options plays. On December 30th, we went into the market, which was Monday. And these funds here, the $49.92 total that we received, I actually captured that in my 2024 wrap-up video update there. So this $49.92 will actually go towards the 2024 totals, not 2025. I know that they expired in 2025, but we opened them in 2024. So that's where we're going to capture this $49.92 overall. So we'll call them the last plays for 2024. We opened two separate contracts. The first one, and that's what this -1 stands for. That's one contract. One contract represents 100 shares. So I owned or do own 100 shares of BABA, ticker BABA. This is a consumer discretionary stock. It is a Chinese stock as well. And we opened that one covered call. Covered calls means that I own the 100 shares. That's why they're covered. I already own them of BABA on the 30th, an expiration date or closing date of January 3rd, which was Friday, for $88 strike price, right? So that means if the stock rose to $88 or above, these 100 shares, the one contract would be called away. I would keep this $22.46, 23 cents per share minus the fees here. $22.46 total, and that is exactly what happened. The contract expired worthless. That means it was under $88 per share. I kept the 100 shares. I kept this $22.46, and I'll probably look to redo it again. I've been trying to run plays on BABA for the last several months. Sometimes they hit, sometimes they don't. The other contract I opened here, again, the -1 contract, 100 shares of Lam Research, ticker LRCX. This is out of the information technology sector. Same expiration date, January 3rd. That was Friday, with a $75 strike price. Now, this one actually closed in the money. That means it was slightly above $75. I think it closed out at $75.11. So we do keep the 28 cents per share minus fees, $27.46 total. We would keep that, but the shares, at least right now, are called away. So we also received $75 per share minus the 21 cents here, $7,499.71 goes back into the portfolio in the name of cash for now, and we will do one of two things with this money on Monday. If it opens up below $75, we will probably just buy back the shares and add them to the portfolio and maybe try to run the covered call again, or we can do a cash secured put, which means that we take the money that we received from this being called away, the $74.99, and run another option play, cash secured put, with the funds to try to buy these shares back at $75 or $74, whatever we think we can do, and we'll get additional options premium from doing that. This is what they call the wheel, right? So we'll run a play on shares that we own. If those shares are called away, we'll run a covered call on shares we own. If it's called away, like Lam Research was, we'll run a cash secured put, try to get those shares back. And then if we do get the shares back, we'll try to do it again, run a covered call, and you can continue that wheel over and over and over again here. BABA, the same thing. We're running a wheel on BABA. It just wasn't called away. So we can just do, instead of doing a cash secured put, we can do another covered call. So again, two options plays that we entered for the week were both covered calls. One expired worthless, the BABA call. One expired in the money, $75.11, I think is where it closed out. So even with it being called away, we are in the positive, right? So it really will depend on where Lam Research opens up on Monday. My hope is that it opens up below $75 per share. We can buy back these shares, keep a little bit of extra cash, and then run another covered call on it. But we'll see what Monday at open looks like. Next up, we'll touch the dividends we received. We got a couple different dividends. They came in on different days. First one here was on December 30th. So again, this will go in the 2024 pile. This was our last dividends received in 2024. They were paid out, $57.03 was paid out by Union Pacific, ticker UNP. This is out of the industrial sector, paid us $57.03. And we do have the DRIP set on the portfolio. That stands for Dividend Reinvestment Plan, DRIP. And in my portfolio, you have to have all of the positions or none of the positions on DRIP. So I currently have all of my positions on DRIP. And that just means that anytime a company pays out dividends, in this case, Union Pacific, the $57.03 in dividends it paid out goes right back in and buys more shares of that same company. So this 5703 bought 0.25126 more shares of Union Pacific. Those 0.25126 shares added an additional $1.34 in passive income over the next calendar year. And that is that dividend snowball that you hear people talk about, or compounded interest you might hear people talk about. So I own shares of Union Pacific. Those shares pay out dividends. Those dividends buy more shares. Those new shares add additional capital, and the dividend snowball continues to grow, rolling down the hill that is time, even if we don't add any additional capital to Union Pacific. Now, Union Pacific is on my stocks to buy for January, or stocks to focus on for January list. So if you haven't seen that video, go ahead and check it out on my page there. Union Pacific, Lam Research was another one, as well as one other there. Lam Research, Union Pacific, and Owens Corning were the three I'm really focused on. Oh, and Oxy, I'm sorry, the four that I'm focused on, Occidental, for the month of January. Union Pacific is probably the least one I'll focus on. Really, Oxy will be the main focus. But again, you can check out that video. I won't get too far into it here. But this is one of the stocks that I wanted to focus on for January. I feel like there's some value here, as well as Lam Research that we saw. I was running the covered call there on the previous. Now, the other one, this is our first dividend payout for 2025. It came in on January 2nd, whenever the market opened back up there. We received $70.02 total from HP Inc., ticker HPQ. This is also out of the information technology sector. That $70.02, again, we have the drip set, went right back in and picked up 1.27127 more shares of HPQ. These 1.27127 additional shares added $1.40 in passive income over time. And again, that's that dividend snowball in effect. I have not added to HPQ in a while, and it just keeps on compounding on its own. Now we get to the first new capital added to the portfolio. Also on Monday, when we went in and opened those options plays, we bought some shares. We did add $1,463.04. So this was our last investment into 2024. So again, this will not count towards our 2025 totals. We'll count it towards our 2024 totals for invested dollars. But we'll cover it here in this week's portfolio because there's a bit of an overlap from last year wrapping up to this year starting in this investing week. So with these funds, we added one more share of Vale, ticker VALE. This is out of the materials sector. This is a mining company out of Brazil. That one share we picked up at $8.93. This is well below my cost basis. I'm going to continue to nibble on this one while it's under $12 here, because that's around where my cost basis is. Added 2 shares to Lam Research Corporation. So this again is one I'm looking to focus on for the month of January. We've actually been adding to this position for several months. I still see a lot of value here. And you can see here, I picked up that share on the 30th for $71.68. That options we ran was at 75. So it did run up quite a bit, but it's been doing that the last several weeks, where it starts out the week $71, $72, $73. By the end of the week, it kind of drops back. It'll run up to 75, 76, and then it drops back at the beginning of the next week. Now, I'm not saying that's what it's going to do. I've just been watching that for the last several months, kind of being the trend that it's in. It's in kind of a range there. So that's why I'm comfortable running options on this one as well. But 2 more shares to our LRCX position. You'll probably see me add some more here next week. Owens Corning, this is also on the list to focus on for January. 2 more shares of ticker OC out of the industrial sector. Picked up those 2 shares at $169.49. And Occidental, this will really be the one I focus on. You'll probably see big purchases like this all through January. 10 to 14 to 16 shares every week is what I'm looking to do, while this one is under the mid 50s. We picked up those 20 shares at $48.59. Another one, I think by the end of the week, this was around $50 or $51 per share. We'll see that here at the end of the video. But the $1,463.04 added to the portfolio on December 30th. All the new shares picked up added an additional $25.95 in dividends over the next calendar year. And on January 2nd, so this would actually be the first new capital added in 2025, we added $448.77 into the portfolio. We picked up 1 share of LyondellBasell Industries, ticker LYB. This is a very high dividend payer here that has really pulled back. So I'm looking to nibble on this one while it's pulled back below my cost basis. I think my cost basis on this one is around $87 or $88 per share. So while it's under that, I want to build this one out. Like I said, it's a nice company that I like. It's also a very high paying dividend yield, and it's really pulled back right now, in my opinion. And the next 2 up were part of our weekly buys for 2024, and they will continue to be part of our weekly buys for 2025. First one, we picked up 1 more share of Vanguard's Total Stock Market ETF here, ticker VTI, at $291.69. And again, I'm going to add at least 1 share of this every week this year. So by the end of 2025, we should have over 100 shares of VTI. We're just over 52. I think this was our 53rd share of VTI. So looking to get this one over 100 shares. Then we might back off a little bit or just continue to add to this one. Depends on where we're at with some other positions. And the other one that will continue to be part of our weekly buys in 2025 and was in 2024 will be Schwab Strategic Growth Dividend Growth ETF here, ticker SCHD. 3 more shares at $27.44. This one is pulled back to just below my cost basis, so I really like this one as well. Might even look to add 4 or 5 shares to Schwab SCHD right now while it's under my cost basis. But we just picked up the 3 shares, which if you are an SCHD holder, there was a recent dividend split. So that's why it's not just 1 share like VTI. I was doing 1. Now I've added it to 3 or increased it to 3 because of the dividend split there that recently happened. 3 for 1. So for every 1 share you had before, you received 3 shares and the price dropped. All right, this $448.77 we added. The new shares it picked up added $12.03 in additional passive income over the next calendar year in the form of dividends. Total invested for the week, like I said, part of it was end of year 2024 there, Monday's investment. Part of it was new funds, first funds in 2025 there, this 448, but $1,911.81 total, and total passive income added $40.72. Now let's run through the sector weights real quick here, see how the overall portfolio breaks down. Communications sits at 10.13% of the portfolio. Consumer discretionary at 4.81%. Let's go back to communications real quick. Verizon is actually below my cost basis right now. Might look to nibble there a little bit. So is Comcast Corporation, so might look to nibble there a little bit. Not talking about a lot, but it is, like I said, Comcast especially is significantly below my cost basis now, I think 6 or 7%. So wouldn't mind adding a little bit there while it's pulled back. But right now, like I said, Occidental, Lam Research, Owens Corning, and Union Pacific will really be the focuses of January, with primary focus on Oxy and Lam Research. Excuse me. Consumer discretionary, a couple here that I'd like to continue to add to as well. BABA, while it's under mid 80s, I think is a good buy, as well as HVT, Haverty Furniture Companies. Haverty Furniture Companies well below my cost basis, around $27 per share is my cost basis. I think it's been bouncing in the $21 to $22 per share range, so wouldn't mind adding to that one. Another high dividend payer there with Haverty, so might want to look at those, or I would suggest looking at those if you're interested in something in the consumer discretionary sector. I think Nike is way down, several others that people are focusing on, but consumer discretionary seems to be one of those sectors that's kind of pulled back right now. Consumer staple sector sitting at 9.33% of the portfolio, not looking to really add much there. Energy, that's the Occidental play that we're looking to add, so we'll be plugging away at this sector here with those Occidental ads over the next calendar month at least, may even going to February depending on where they sit. Financials is at 2.75%. If we ever had a pullback in American Express or Visa, something like that, I would like to add one of those. I'm really leaning, to be honest with you, towards American Express. I think everyone's focused on Visa, but I think American Express might be one that's kind of overlooked in that vein of the credit card payers there. Healthcare sector is sitting at 11.84%. Johnson & Johnson is still pulled back. That would be one I wouldn't mind adding to. Pfizer is below my cost basis as well. CVS is another one well below my cost basis. Actually, CVS is I've got a 30% loss right now currently. If I was to sell it and lock in that loss, I mean, there is no loss unless you sell the shares. There's no gain unless you sell the shares. But right now it's 30% below my cost basis. Wouldn't mind adding a little bit there as well, even though it is one of the larger positions in the portfolio. It has pulled back. Healthcare is another one of those sectors that has really pulled back, as well as industrials. Consumer discretionary, healthcare, industrials, I feel like those have really pulled back, at least, and as well as some of the REITs also out there. But let's continue here. Healthcare 11.84%, industrials makes up 6.75%. Union Pacific and Owens Corning, both of those positions are in the industrial sector that I'm looking to add to as well. So probably get a little bit here. Technology, that's the Lam Research position, falls in the technology sector, so we're looking to add there. So this might be able to get up to 15% if we continue to add, but currently at 14.29%. Materials makes up 7.74%. That Valet position and LyondellBasell are two positions I wouldn't mind building out there. Materials is another one that's really pulled back overall as a sector. Utilities makes up 8.05%. REITs and real estate at 8.13%. And ETFs, eventually this will be the largest position largest sector just by the nature of adding to VTI and SCHD every single week. Over here on the right, you can see the percentages as well as the dollar amount allocated to each position as well. Financials being the lowest at 2.75%, obviously. Like I said, I wouldn't mind adding another position there just because it is such a small slice of the pie. Now here it is, and I show this every week. I think it's important as someone who's in the financial space here on YouTube. I see a lot of videos out there with people talking about their portfolios or trying to quote unquote not give financial advice while talking about finances, which is what I do too. I'm not giving you financial advice. I'm just showing you what I do on a weekly basis. So hopefully it gives you some encouragement that you don't have to be a guru. I'm not a guru. I didn't go to college for this. I don't work at this every day. I'm from the construction industry, really. That's my background. My dad was a mason, so I got into it very young. So I am learning as I go. I do my own investments. I don't pay a broker fee or as little fees as I can because I think it's better invested. But I think it is also important, since I am in the financial space, to show my real portfolio every week so you can see what I'm doing, see the ups and downs of the market and ups and downs of individual positions. And it's okay if you don't want to invest in individual positions. If you want to just go the ETF or index fund route, right? Warren Buffett would recommend something that tracks the S&P 500, so something like VOO, Vanguard's S&P 500 index. I think Schwab has one as well that tracks the S&P. SPY is another one that tracks the S&P. So that would be my recommendation for people who don't want to do the research into individual stocks. Just stick to a S&P index fund or ETF. That's what I would do. I also do SCHD because I like the dividend payout at around 3.6%, as well as the growth around 11.94%. I think you can't get a better mix of dividend payout as well as dividend growth. I think it's a great, so you could go that route. If you're a dividend growth investor and just want to do one, SCHD or VYM, I think is Vanguard's equivalent to this, a couple other ones out there as well. You don't have to do individual stocks. But for those of you out there who are doing individual stocks, again, I think it is important that you see, right, you're going to have ups and downs. Every single one of these positions has a 52-week high and a 52-week low. And every one of these positions in my portfolio, your portfolio, the overall stock market, can touch those 52-week highs at any time throughout the year, set a new 52-week high at any time throughout the year, hit that 52-week low again at any time throughout the year, or set a new 52-week low at any time throughout the year for a multitude of reasons. Earnings reports are bad, future projections are lowered, negative news around the company, something happens, they get a new CEO that people don't like, someone quits, someone's fired, they have issues with the company overall. There's a multitude issues around the world. A war breaks out or something. It might impact oil and gas, for example, or the industrial sector, companies that make planes, weapons, that sort of thing, bombs. Lockheed Martin, companies like that might be impacted by wars. So there is a multitude of reasons that companies can go up or down throughout the year. Just sentiment, right? A bunch of people feel like the company is going to go up, so they start plowing into it. But if you see red, that is not necessarily a reason to sell a company. If you've bought good companies, you've done the research, you understand what you purchased, you've done a discounted cash flow analysis or one of the other many ways there are to value a company, set a price, and you've bought that company at a decent price, what you feel is a decent price, and you see it cheaper, like Comcast. We'll talk about Comcast, again, below my cost basis. But if I thought Comcast was a good buy at $40.85, and it's now $37.66, and nothing has changed with Comcast, why wouldn't I continue to buy it? Just because it's down 7.81%, I shouldn't run away from it and say, oh my God, it's a terrible company. I need to sell it right now. Well, then I'm locking in a $703.53 loss, right? I haven't lost anything. Even though that says it's negative, unless I sell this right now, I do not lock in this loss. Now, as soon as I sell the shares, I lock in the loss. Same thing with Cisco here. I'm up 22.81%. As soon as I sell Cisco, I lock in that gain. But right now, just because it says I've made a gain, that does not mean a thing to me unless I sell the position. So again, if you've done the research, you know the companies you bought, you know their revenue is growing, their margins are expanding, their projected sales look good, they're buying back shares, they're paying down debt. Whenever you see those negative days, those should be the times that you're buying more, right? You don't run into a store and say, I'm going to buy a pair of shoes. Let's use shoes, for example. I'm going to buy a pair of shoes for today. I looked online, the pair of shoes I want, $60. I go into the store to buy the shoes. I walk in, they've got a sale. The shoes are only $50, $15 off. Do you run out of the store and say, oh my God, those shoes must be terrible. That's why they're selling them cheaper. No, you probably buy the shoes and then maybe you buy a couple pairs of socks to go with it because now you've got $15 additional to spend. Well, you should treat the stock market the same way. It seems like the stock market is the only market where people see a sale. That's these positions in red, in my opinion. So long as the fundamentals of the company haven't changed, it should be these positions in red, and I should be adding to these positions. Now, that doesn't mean you only focus on the positions that are in the red. I certainly do not. Like I said, Owens Corning, I'm looking to buy some more shares here. I did buy some more shares. Well, I'm up 54.96%. Oh my God, it's so expensive. I shouldn't be adding. Well, there are times over the last month or so that I was up 90%. So it's been pulled back 30 to 40% right now. So I should be adding to this, even though I'm up 54.96%. So that goes the same way. Just because you see something that's run up doesn't necessarily mean it's expensive. It may indeed still be cheap, but you need to understand the company and have an idea of what price you're willing to pay. All right, I'm going to get off my soapbox, but that's why I show my portfolio every week. You're going to see out in the open what I'm doing, what I'm buying. If I sell anything, you'll see that. Dividends I receive, options I receive. I want you to see a real portfolio built out over time. So like I said, you can understand that you can do it too. You don't have to be a guru. You don't have to be a college educated person, have gone to school for finances, or be from a family that's got a bunch of money. Over time, you can build out a portfolio and do exactly what I'm doing. You may not get the best returns. I mean, I'm only up 4.71%. Is that the greatest returns? Probably not. But I know what I'm buying. I'm buying it for a reason, and I'm not concerned with short-term gains or losses. I'm concerned with a long-term portfolio, and this over here is circled in red. But we'll get there in a second. So in this column, we'll see all the tickers of all the different positions in the portfolio, how many shares I own of each, the current price as of close of business on Friday, and all of these numbers will be as of the close of business on Friday. Market value of each individual position, how many, or my average cost per share, my purchase price. This does include reinvested dividends, guys. So whenever you see this $6,236.97 purchase price, that includes the funds I've put in as well as the dividends reinvested. We do have the drip set on this portfolio, so this will change over time as the dividends are paid out, even if I don't add to these positions. Total return, whether I'm up or down, you're going to see it here. Percent return here. Sector that each company falls in, whether they're a quarterly, monthly, semi-annual payer. Current yield as of the close of business on Friday. My yield on cost. The portfolio weighting here. So what we saw on the previous slide was each sector weighting. This is each individual positions weighting. I do have a rule in the portfolio. I do not want any one position to be more than 10 to 15% of the portfolio. I don't want any one sector to be more than 20 to 25% of the portfolio. Estimated annual income in this column, payout months here, dividend growth year over year, and this will change. We see a couple companies have already announced dividend raises that will impact 2024 numbers, so we'll highlight those throughout the year as they do. Enbridge has recently raised their dividend, so their next dividend paid out in 2025 will be this new number. Same thing with Owens Corning here in January. It will be the 69 cents. I think it was 60 cents before. Pfizer just went from, I think, 42 cents to 43 cents. VTI, this is an old one. I think that they recently adjusted their payout as well. Vale recently adjusted their payout as well. I have to go back and look at that one because I'm kind of questioning whether they did or not. But I'll go back and look at that one and verify. But dividend growth year over year. So as they adjust these payouts, we'll adjust this dividend growth column. And where it sits at 15% of a 52-week low, same thing. This will adjust over time as the 52-week low adjusts up or down. If a company sets a new 52-week low, we'll go back in, redo the math, and adjust these numbers. But this column here, I use this as kind of a high benchmark of where I want my average cost per share to be. So for example, 15% of 52-week low for Ally is actually $33.40. So even though it is currently above my cost basis, my average cost per share $25.89 at $35.84, I could add to Ally. Yes, I would bring up my average cost per share, but so long as I kept it under $33.40, I'm comfortable with it being below this 15% of a 52-week low. And that's kind of what I use this number for. All right, so let's wrap this one up here. Total shares, 6,453.858 shares. Market value of the portfolio, $314,400.13. I have $300,262.31 into the portfolio. Again, keep in mind this does include reinvested dividends, so it's not just cash out of pocket. Total return, I am up $14,137.82, but does that really mean anything? It means something if I sell out of everything in the portfolio. So if I sell all of the positions in the portfolio and just cash out, I would pocket an additional $14,137.82, which that's nice, but I'm not planning on selling out of all the positions in the portfolio. So does it really matter? I mean, I would say no. Percent return here, I am up 4.71%, but again, does it really matter? I say the same thing. I'm not focused on this. You've seen me up 12, 14, 15%. You see me down 12, 14, 15%. I don't focus on this. Not what I'm really focused on. Current yield, 3.959%. Yield on cost, 4.146%. And this is what I'm focused on. That's why it's circled in red over here. The dividends paid out by all the different positions in the portfolio over the next calendar year, and this continues to go up week over week, month over month, quarter over quarter, year over year as I add new capital, as the positions in the portfolio raise their dividends, and as they pay out dividends and buy more shares because we have the drip set. This continues to go up, again, whether the market's up, down, or floating sideways, and currently sits at $12,447.97. Love to see this. I think by the end of what my focus on, or what I'm trying to do over the next 4 quarters, I'd like to add at least $1,000 in dividend income per quarter. So I'd like to see by the end of March this at like 13.5, then 14.5, than $15,500, $16,500. I'd love to be around $17,000 to $18,000 in estimated annual income by the end of the year, if not higher. We'll see how that goes, but that is kind of a goal for the portfolio. Can I get to $18,000 in estimated annual income by the end of the year? That would be nice to see. Dividend growth 6.65%, but again, we'll adjust this as the dividend payouts here. Several of the companies in the portfolio are still at zero raises. Google, for example, I'm expecting them to show their first dividend raise here shortly before March. So we'll adjust this as they do their dividend raises this next calendar year, and I'm hoping to get this dividend growth year over year into the 7% range as well. Well, that is really it for this one. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community. I do personally read and respond to the comments. I am always interested to read your questions, opinions, or suggestions for future topics. So again, I do the Stock Pick of the Day video series. If you have a company you'd like me to cover in the Stock Pick of the Day series, drop it in the comment section down below. Love to hear from you. What are you buying? What are you adding to your portfolio right now? What did you buy this week? What are your goals for 2025? Drop them in the comment section down below. Do we own any of the same positions, and are you adding to any of those positions right now? Again, love to hear from you. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Thanks for tuning in. Hope you have a great week, and we will see you in the next one. Happy New Year, and good luck to all of you this year in your investing journey. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I am only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk. You can lose money. You should never invest any amount you are not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice and counsel of a certified financial advisor.